In this presentation, we're going to create a loan amortization table, and this will help us to track our loan payments and break out the principal portion and the interest portion of them. Let's get into it with Intuit's QuickBooks Online. Here we are in our Get Great Guitars file. We're going to first start off with our reports. We're going to go down to the reports down on the left-hand side, and then we're going to be opening up our favorite report, that being the balance sheet report. Opening up the balance sheet report, scrolling up top, we're going to be changing the dates from 01/01/20 to 12/31/20. Then we're going to run that report. Then I'm going to close up the hamburger to get it out of the way so it doesn't bother me, and I've got the 125 on the zoom, holding down control, scrolling up to get there. Now we're going to scroll down to the liabilities. We're concentrating in on the loan payable that we had just consolidated to the $72,000. Now the $72,000, we're going to make payments on that loan now, and we're going to say that this is going to be structured kind of like a standard type of loan when we have a car loan or something like that, in which case we're going to pay it off in monthly payments. However, those monthly payments include both interest and principal within it. So that complicates how we're going to record the loan into the system, because when we record it, we can't simply just write a check and decrease the loan account. There's going to be three accounts that are affected. We're going to have interest affected, the loan account affected, and of course cash going down with every payment. Not only that, but the amount that's going to be allocated to the interest and the principal is going to be different every time we make a payment. Why? Because of course when we're trying to make the payments, we're trying to make them standardized, the same payment each month. But it really kind of shouldn't be, because the interest changes as the principal goes down. So in order for us to standardize the payment amount, we have to adjust the interest and principal portion of that standard payment amount. For that, we need an amortization table. So for this presentation, we'll actually make one in Excel. So this isn't an Excel course, but I want to be able to just go through Excel and put together an amortization schedule for a few different reasons. One reason is that we need to understand the relationship between the interest and principal so we can come up with some kind of system to enter this into QuickBooks. Once we have that, we can come up with different systems to enter it into QuickBooks. We can enter it according to the amortization schedule each time, or we can basically have an adjusting entry. We could work with a CPA firm possibly and enter it one way, and then ask the CPA firm to make the adjustment at the end of the time period to account for the interest or something like that. But in order to do any of those systems, we need to know what the interest and principal, what we're talking about with regards to interest and principal, and making an amortization schedule is a great way to learn that. The other reason is that because oftentimes when you finance something like a car or something like that, they may give you all the information but not an actual amortization table. And so then you would basically have to create one or ask your CPA firm or something like that to make the amortization schedule in order to properly break out the interest and principal. So that information isn't always, you always don't just have the amortization schedule, even though you have the information basically to make one up. What they typically give you is the information and then what your monthly payment is. They don't really break out the monthly payment, interest, and principal per payment, which is what we need to enter it into the system. Therefore, we can take what they give us and basically make an amortization schedule. And it would look something like this. You could do it in Excel. So we're going to say we have an we're going to say that we have a loan for $72,000. We're going to say that there's monthly payments for 60 months, which means it's basically a 5-year loan, right? So if we have 60 months divided by 5, 12 months, or 12 times 5 is the 60 months. So there's going to be monthly payments 60 months over 5 years. So we're going to be making monthly payments for 5 years or 60 months. And then we're going to say the interest rate is going to be 5%. And then we can have the payment amount. Now they're typically going to give you the payment amount, but let me just show you how you can basically calculate the payment amount. Because in a typical kind of loan, if you're trying to figure out what your payments would be with different types of loan options, you can use Excel's formula for the payment amount. So this is a common formula to use. So let's just take a look at it. One way you can get there is go to the formula tab over here, and we can go to the insert function, which will give you a format box, kind of helps you out with the payment. And then I'm going to type in what I'm looking for here. I'm going to say loan payment. That's what I want to calculate, loan payment. And then this second one here is the one we're looking for, the PMT, calculate the payment for a loan based on constant payments and constant interest rate. So I'm going to say, okay, that's the one I want. Then it gives you a little formula box to help you to fill this thing out. So we can then say that the rate, what's the rate going to be? It's going to be that 5%. Now, this is the tricky piece because that 5%, whenever you hear interest rate, it means per year unless said otherwise, just the convention that we typically have. And we know now that the rate is basically going to be per month. So that is the yearly rate, which we're going to divide by 12 to give us the monthly rate. Then we're going to say, okay, then we're going to have the number of payments, which is going to be 60. So I'm going to say 60 payments is going to be this box. And then we need the PV, which is the present value. The present value is the loan amount, the amount of the loan at the current time period, which is the $72,000. So that's what we need. These two are not necessary for the calculation we're doing here. This should be calculating our interest payments. So I'm going to go ahead and say okay, and there we have it. That's going to be the payment amount. Now, I like to see it as a positive number, so what I typically do is I just double click on the thing, and I put a negative in front of the P, which basically just says, hey, take that number and flip it, make it a positive number, please. So we're going to put a negative in front of the P, and there we have it. Now, this is often the information you'll have. They'll give you this in a contract type format, and that's great. You know what your monthly payments are, and I know what the interest rate is. I can figure out the total interest rate and whatnot, but I can't figure out, easily what the interest is per payment. How much interest per payment of this amount do we have? We don't know because it'll change each time given the format of the loan. So that's one thing I just want to show here. Also note that it could be possible that you have all the information, you have the payment information, but for example, don't know the interest rate, right? Or if you have any other kind of unknown, you can also use this same formula. There's different types of formulas. So for example, if you wanted to learn or know what the interest rate was based on you making payments of, or someone making payments of $1,359 for 60 months, and the loan being $72,000, and you're saying, well, then what's the interest rate? They didn't give me the interest rate. They just told me what my payments are, and they told me the monthly payments and the loan balance, but they didn't give me the rate. Well, we could figure that out. They still gave you all the information to be able to figure that out, right? So we could then say, what if I delete this? Now, notice that this amount, I'm using the same formula down here. Even though this is an unknown right there. So I'm going to say that's the unknown. And instead of having a different formula, we could use a different formula to solve for the unknown. I'm going to keep this formula, and then I'm going to ask Excel to just, hey, Excel, put whatever you need to put there in order to make the balance what I know it should be, which is 1359. That way I can use this same formula, which is a more common formula, to basically figure out the interest rate. And so I just want to show you this tool because I think it's a nice tool to have, and I like to show it off anytime, it could be useful in different situations. So that tool that I want to just show you here is going to be in the data tab up top. It's going to be in the forecast, and it's called the what if analysis. So I'm going to go to the what if analysis, and we're going to be using the goal seek tool, goal seek. Now this is what we're going to say is Excel, I would like you to set this cell, make that cell B, and then I'm going to hard code this number. And also note that I'm not actually on any cell. I can be anywhere in the sheet because it's not this. I'm not making a formula in this cell. I'm asking Excel to do a function for me by basically trial and error. So then we're going to say we want to change it to, and I'm going to hard code this number 1359. That's what I want it to be, and I want you to get it there by changing this cell. So let's think about that again. We're going to say, hey, Excel, please set this number right there to be 1359 by changing this number. And then I'm going to say, okay. And Excel's just going to keep on trying whatever it can try to get to the proper percentage, and it gets to the 5%. So note, you can use the same format even if the contract doesn't give you the percentage and it gives you the payment. You can kind of back into the percentage. You have all the information you need to back in the percentage. Notice it's not exact here because we have rounding involved. I'm going to put it back on just the 5% and just realize that I have rounding on. So if I was to increase the decimals, it's actually 1358.73 and so on. All right, but I'm going to take away the pennies, and then we're going to go down here. Now we're going to make the schedule. So once I have that information, I can say, okay, well, how much interest and principal am I paying per section? So for that, I'm going to have the headers up top, the payment number. This is the number of payments, which is simply going to be 1, 2. Then I'm going to highlight those two, and I'm going to go to the autofill. scroll all the way down, and there should be 60 of them, right? I'm just going to go down to 60, and there's 60 payments. Then we're going to have the payment amount, and actually, sometimes I like to actually start at 0 here. I'm going to start it at 0, and then 1, and then we'll bring it all the way down to 60 payments from there. So I'm going to 60 payments, all right, and we're going to bring this down like so. All right, let's go back up top. Then we're going to say that the principal amount, and so the principal is going to be the amount that is still owed on the loan. So at times 0, it just equals the 72,000. Then we're going to have the payments. The payments are always going to be the same. They're going to be this 1359. Again, remember it's rounded, so there's some pennies there, so there's some rounding. And then we're going to calculate the interest. So the interest then is going to be calculated as, if I scroll back up top, it's going to be the 72,000 times 0.05. That would be for a year, however, interest for a year, and we only want a month, so divided by 12. So there's the 300. You can also think of it as the calculation we had. 0.05 is the interest for a year divided by 12. That very small number would be the interest for a month. If you move the decimal over, it'd be 0.4166%. That's why we don't usually use monthly interest, because the interest rates would be very small. That's why we typically default to a year. Then we're going to say that times 72,000, and that would be the 300. So let's calculate that with a formula here. I'm going to say that equals the 72,000 times the 5%. And then I'm going to double click on that and take that and divide it by 12. Now you could put brackets. You don't need brackets because it's all, order of operations. It'll multiply and then divide. So we're going to say, okay. And then that means the principal is going to reduce by the amount of the payment minus the interest. So remember, the interest is the rent. Like if you're just renting an apartment, you got to pay the rent on it. We rented money. That's what the interest is. We're paying the rent on it, interest, $300. And then we're paying down, the rest of it pays down the actual principal that we borrowed. We're giving back part of the apartment. We're giving back part of the money, the value back. And that's going to be the 1,059. So that means that we have now the new principal, 72,000 minus the reduction in principal, or 70,941, this minus this. Now, so note, if I keep doing this, there's going to be a change in the amount of principal and interest reduction, because we want the payment to remain the same so that we can budget our cash flow. That's kind of why we force the payment to be the same. But by doing that, we have to vary the interest and principal. Why? Because now I'm not renting as big of an apartment, which is the analogy. I'm not renting as much money. Therefore, the amount of interest is less for month 2 than month 1. So if I was to calculate it, it would be now this number times the 5% divided by 12, which is a little bit less, right? And then I would say, okay, now the difference is the payment minus the interest, which is now a little bit more of principal, because it's the same payment, less interest, more principal. Then the principal is going to go down by this number minus this number. Let's do it one more time, and then we'll autofill all the way down. We'll practice the autofill. So it's going to be the same. I'm just going to say equals the same number as above. Interest is going to be equal to this 69,878, which is now the principal, times the 5%, which is up top, divided by 12, because we're doing this monthly, not yearly. A little bit smaller of principal, and now we're going to say the total payment is that minus the principal. Now the principal reduction is now higher. The amount that the principal will be reduced by is higher than prior month. The prior principal minus the principal reduction brings the principal down to here. Now I'm going to try to autofill this all the way down and see if it does what we want. I'm first going to highlight these cells. I'm going to do this with one cell, and then I'll see if it did what we want. Then we'll go back to it. So I'm just going to autofill down and say, does that do what we want? I don't like this. Something happened there. This one did what we want. This one looks out of whack. Why? Because it brought the 5% down. I don't want it to bring it down. I want it to stay at that 5%. I tried to bring it down, so I'm going to use an absolute reference there, and then it should be okay. So I'm going to delete this, and then I'm going to go back to the interest portion, double click on it, and see this one in X4. That X4, I want to make an absolute reference. To do that, I'm going to push F4 on the keyboard, or you can simply put a $ before the X and a $ before the 4. You really only need a $ before, I believe, the 4 to make a mixed reference, but an absolute reference would be fine. And that basically tells Excel, hey, don't move that cell. When I copy it down, don't move that cell. Because the convention would be to move every cell down in relation to the copied cell. So I'm going to say don't move that one. Keep that one where it is. So now I'm going to highlight these 4 cells again. Use the autofill to fill it down once again. This one looks good. This one now looks like it's doing what we would expect, what we want. This one looks good. This one looks good. Now I'm going to go ahead and autofill all the way down. And once we get to the bottom, the principal number should be at 0. That's kind of like our check figure that we did this correctly. So then I'm going to put my cursor right here. I'm going to autofill all the way down. So auto drives it down. Dr. Phil's going to do the calculations and then let go. And there it is. So now we're at 0 at the bottom. Look at this last payment. Notice how big of a difference you have. Same payment amount, but very little interest involved on it. And it's all principal. So that last payment you make on the loan is basically all principal as compared to the first payment you make on the loan, which is basically has a lot more interest involved in it, right? So that's going to be our transaction. Now, when we start to make the payments then, this first payment is going to involve the same amount decrease in the checking account, but then it's going to involve the $300 of expense and the principal is going to go down by the $1,059. Then the second amount is going to be same amount of cash going out of the checking account, but interest is now going to be less and the principal reduction more. Therefore, this is why we need the amortization schedule to record the payments properly. Now, note you can also do this periodically. You could come up with a system and just say, hey, I'm just going to record everything to the loan and then have my CPA adjust the interest portion periodically, monthly or yearly. Or you could say, I want the accounting department just to record it to the loan, and then we in the adjusting departments or at the end of each month will record the interest in accordance with the amortization table. That way, you can make the data entry very easy, very repetitive, and so it'll just copy the last transaction, and then you can simply adjust it from time to time. So that makes the data input a little bit faster.